Welcome to the New England and New York Real Estate Journal podcast. I'm your host, Rick Kaplan. Today's guest is Rod Kritsberg. He is the co-founder and CIO of KPG. He leads the development of the firm's investment strategy, sources and structures, acquisitions, and credit-related opportunities and development, maintains and develops new client and capital partner relationships. Mr. Kritsberg founded KPG in 2014 with the goal of melding a quality approach and the depth analysis typically found at larger companies with the individual attention to transactions and street-level real estate knowledge that characterize boutique firms. To date, Mr. Kritsberg and his partners have established KPG as a competitive real estate firm in New York by leveraging relationships with institutional and private investors and local brokers, and by generating above-market returns on transactions. I'd like to introduce my guest, Rod Kritsberg from KPG. And Rod, you're going to tell me a little bit about what you're all about and what KPG is all about and what makes it so unique.
Yeah, well, that's a good question, right? So we are a, we are a boutique office developer. What we focus on is sort of ultra high-end space in New York City markets where tenants want to be, right? I think that's us in a nutshell. We're high design. We care very much about finishes, architectural significance of the assets that we buy, whether they're, in a state of needs repair or complete teardowns. That's what we focus on. We take kind of architecturally significant B and C buildings and turn them into Class A gems. That's KPG Funds in a nutshell.
So let me get a little idea of your background, because that's going to tell me why you chose to go this route in the commercial real estate industry.
When you said, well, how far back do you want to go?
Well, not to kindergarten, but
no,
maybe
not that far back.
Maybe the early years when you started in the commercial real estate. Now, did you start in commercial real estate, or were you in?
No, it's a great story. It's a great story. I actually started. I actually started about 20 years ago. Oh my God, if you can imagine, about 20 years ago in residential real estate. That was when I got my feet wet in real estate in general. I was back in college. I started renting apartments. It was New York City, built from the ground up. So I started all the way from the bottom. And sorry, there's all of a sudden a lot of noise where I am. So it started from the bottom, started there, and sort of worked my way through all of real estate. Started a commercial brokerage firm as a very young man, sold that off to one gentleman, left that company, got with a very large family office, ran acquisitions for them. When I left there, started doing deals on my own, and then linked up with my now partner, Greg, who was running a big brokerage house here in New York City. And we had very complementary skill sets, and we started KPG Funds. That's a story. If you want to get more specific, yeah.
So you kind of touched on a lot of parts of this business going up in it. Yeah.
Well, give me the specific question. What do you want to know? I can give it to you as detailed as possible.
My question is, KPG it's kind of a unique concept because you talk about a value added. So you're looking for properties that are in distress almost in a lot of cases, and you're finding added value to that.
So look,
that tells me that you have a lot of vision,
It's funny. A lot of people say value add, and value add just means something on paper, right? What do we buy? We buy real estate that we love, that we can turn into something beautiful. And more importantly, we buy the type of real estate that we know we can lease to tenants, right? It's a question of tenant demand. Where do tenants want to be? What is the modern workspace? Right? Because having this conversation today and just talking about the past doesn't matter, right? Because we're in a different world today from what we do, right? Because we're hyper specific, right? We do office, we do boutique office, we do ultra high end boutique office, right? Now, we were doing that pre-pandemic. And then what happened was pandemic hit, and all of a sudden, that's the number one thing in the marketplace. All of a sudden, that's what everybody wants, right? They want control of their own space. They want technology in the space. They want show floors. They want to attract and retain talent. The pool is limited. How do you get people back to the office, right? And it's not that we pivoted to that, which is now the thing du jour, right? We've been doing that. We've been delivering a product that is far and away the best in the market. And that's just been proven by the rental rate numbers that we get and demand that we have for, product in our portfolio, which is almost 100% leased, when others may not be able to say the same thing. And, the point to all of this is, right, it's a love of real estate. It's a love of architecture. And it's an understanding of where tenants want to be. I mean, it's kind of that simple. You don't have to reinvent supply and demand. You just have to follow the trend.
So you're actually working with a high-end client.
Yeah. I like to call it the 1% of tenants, okay. Right?
The 1%. I like that.
The 1% of tenants. I mean, it is what it is. I mean, that word or that phrase might have some negative connotation in some parts of the world. But look, the reality is I'm going to say it, and I'll say it 100 times, right? We take architecturally significant buildings that are B and C, that have been unloved for years, underserved, not touched, and we fully renovate them, but we keep that same aesthetic, right? I like to think of it as like, what do the tenants want, or what do these CEOs and business heads imagine office to be in their mind's eye, right? We're talking about the type of companies and CEOs that ultimately make these decisions that live around here. Like, where the majority of our portfolio is very specific. Where do we focus? Soho, Union Square, West Village, Hudson Square, Meatpacking. That's where we focus our gaze, right? The majority of our portfolio is in Soho. Why is it in Soho? It's because these assets, these buildings are absolutely gorgeous. And historically, every time they were vacant for value add, they went residential, right? So every time a building would become vacant, some residential developer would buy it up, snatch it up, and make it residential. Most of the time, these commercial redevelopments didn't happen because they're very difficult. There's a lot of barriers to entry. There's a lot of red tape to go through, because you're not just dealing with the Department of Buildings, you're dealing with the Landmarks Preservation Commission. And a lot of people want to cut corners and do things, kind of halfway, right? Half steps. And that doesn't work, right? So what the modern tenant wants is a really high-end modern office. They want a new build. And how do you make a new build out of a building that was built in 1880? You have to completely gut renovate it. So you take, some of our beautiful cast iron architecture. I don't know if you can see some of it in the background. I'm sitting in my Soho office right now. So you take some of it, that beautiful cast iron architecture, and you do an incredible renovation to it. You rip out everything except the four perimeter walls and, the cast iron vertical columns, and you start from scratch and you build a brand new building on the inside. And when you deliver the type of finishes that we deliver, right, which is, I like to call them high-end residential condo finishes, right? You attract that 1% of the tenant base that isn't out there looking for the budget deal. They're not out there looking for what's the most I can get for my money. What they want is what they want, right? And they know it when they see it. We pre-build the spaces so they don't have to think about it, right? We do boutique space. We're talking 5 to 15,000 feet. These companies don't take a long time to move. They don't take 2 years in advance to move. They walk in, they see the space, they love the space, they move in. We can get them in 30 days, right? And that's been our success story. We deliver the type of space that companies that are doing well can move right into, and have the sort of physical attributes and location that'll help them attract and retain talent, attract and retain investors, and be a real showpiece and addition to their company, right? Not just, oh, we have some space somewhere in Manhattan. No, come on over and see it. You'll be impressed.
So let me ask you about the Bernardo property. Now, they're in the Soho area, correct?
Yeah, they are.
So why were they not successful? Were they just didn't care about the properties? And
if I'm being honest, I can't speak for them, but I can tell you that they are a massive organization, right? And kudos to them. What they're doing over in Penn Plaza is unbelievable. But we're talking about billion-dollar buildings, right? That they're building. These assets, were part of a portfolio, and from my understanding, because a lot of them have come onto the market since, they had constructed through multiple acquisitions a pretty robust Soho portfolio of smaller type assets. My guess is to be run together, maybe as like an urban mall, very retail focused, right? And when we came in to buy these assets mid pandemic, our focus was office. We weren't scared of the retail. We knew that the market would recover to a point just because we were in the market and we knew what was going on. And we were willing to come in and maybe do the work that maybe they didn't want to do, or, didn't have to do, or didn't want to focus their attention on, when they have, bigger things going on in their portfolio, right? Because ultimately, even though they're great assets, the two assets that we bought from them, relative to the other things in Vornado's portfolio, they're small assets, right? One is 60,000 square feet, one is 75,000 square feet. Again, I think their focus is on the 1 million square feet plus. They're building in Penn Plaza.
Right. This was
anyway, so that's.
It was easy to unload from their
portfolio. And I think that there was just a shift in urban retail, and it was the right time. Look, you have to understand, when we did these deals, we dug our heels in when the pandemic hit, and we had a lot of potential problems in our portfolio. I say potential, right? Because we had a lot of buildings. We had multiple buildings that we were delivering mid-pandemic, and multiple buildings under construction that got tremendous delays because of the pandemic, right? You couldn't get crews. First of all, the city was shut down, and then when it was shut down, you couldn't get crews. Right. I mean, it was everybody will tell you the story. But the thing was, we doubled down because we absolutely believed in this city, right? We have lived through multiple cycles, right? And not to say that COVID was like any other financial cycle, just to say that I've been here my whole life, and I've lived through professionally multiple cycles, right? When, New York always seems to get hit first, right? And it feels like it's the epicenter of the last sort of 3 massive downturns. And then it always recovers the fastest. And you can kind of go back, right? We had the Great Recession that was here, right? You go back, kind of September 11th, that was here. And then COVID, where did COVID hit first and hardest, right? And then yet out of those 3 massive, terrible things that happened to our economy, New York survived and thrived, recovered the fastest. And we were completely convinced that was going to happen here. But the thing that we were also very, very cognizant of is, if you were here during the pandemic, you knew that the neighborhoods were the haves and the have-nots, right? If you were in certain neighborhoods, like where I live in Tribeca or my office is in Soho, the streets were bustling. Young people were out. The restaurants were full. You couldn't get a reservation. And then you went to some places in Midtown, and it was bit of a ghost town, it was a little eerie, and what we said to ourselves, we look around, we say to ourselves, look, if the people want to be here, then ultimately they'll want to office here, right? Like I said, high barrier to entry, everybody always wants to be here. And if we can create more supply in a demand-starved market, or supply-starved market, a huge demand market.
No, so obviously KPG is a very unique concept and how they operate. So is that limiting the amount of competition you run into? And did you
Well, there's a lot of copycats. There's a lot of copycats.
Okay, well, I can see once they see that you're successful doing it, everyone's jumping on. But now, after the pandemic, and I know for a fact in a lot of New York, lots of parts of New York, and a lot of the neighborhoods in the Manhattan area, they were deserted. A lot of buildings did kind of get run down during that time frame.
Yeah.
And I know there were a lot of property owners that were also looking to unload at that time because they were getting nervous.
Yeah.
Did you take advantage of other neighborhoods?
We did our best, but there was a lot of chatter, very little transaction volume. If you want to be very honest, a lot of groups said they would leave, but if you actually look at the transaction volume, it was down significantly. The reason for that is there wasn't that much downward pressure from lenders, right? Because what happens? A building goes vacant, right? A building goes vacant. What do? You can't pay your mortgage.
Right.
But what we noticed specifically I'm going to go pandemic time, specifically during that time, banks worked with borrowers, right? Because they did across the board. And then it kind of cycled through that. And then there was a little bit of a recovery. And I think towards sort of the tail end of last year, we were seeing a little bit of that. At the beginning of this year, we were seeing a bit of a recovery. And we have been very busy, through these years buying up assets. So we did buy, a few more assets. I think we bought 4 assets through, 20 and 21, when most groups that do what we do were sitting quiet. We delivered 3 assets, 2 specifically, like right in the middle of the pandemic, that are 100% leased at this point. I'm lying, 98% leased. And then, we also, kept our eye focused. The reality was, when people saw how successful we were with our projects, I feel like we got outbid a couple of times when other groups might have heard that we were bidding, and they said, well, if these guys can do it, we can do it too. I'm not sure they can. I think people always ask, kind of what makes us successful, right? It's 2 things: sourcing and leasing, right? That's what we pride ourselves with. That's what we think we're the best at, right? We see the deals that nobody else sees. We do deals direct. We take the step that most other landlords won't do, right? We're proactive, not reactive. We hit the phones ourselves. We make relationships with our contemporaries, like a Vornado. We call them up and say, hey, this couple parts of your portfolio, maybe you want to transact with us, do a deal. Great. We don't need to sit around and wait for some broker to call us and be 1 out of 100 phone calls that he makes that day for a piece of property he's trying to sell, and then wait for that property to get bid up, right? That's the sourcing side. And then the leasing side, it's exactly the same, right? So, we're engaging with the tenants ourselves. We track the tenants in the markets. That's, we also have something called RSSI. It's an index that shows the relative strength of the submarket, right? And that tracks, what does it track? Simply demand, supply and demand, right? It's available space in the market against the tenants searching in that market. And that relative strength of that submarket is what guides us to what markets we want to buy in, where we want to be in. There's still some great opportunities. Well, let me rephrase. There's some very cheap deals available in some submarkets where there's no tenancy. So great. So you can buy a vacant 100,000 square foot building. Somebody gave you that building for free. where do you find 100,000 square feet of tenants in that submarket, right? So we're focused on sourcing where the tenants want to be, delivering really high-end space that they want, and then having direct communications, leasing, directly with our tenants. Obviously we work with brokers, and there's a lot of great brokers that we work with and that we love and respect. But it's that personal touch, right? It's that direct to ownership relationship with our tenant base that really helps us, close these deals, close these leases, and get things across the finish line, keep a healthy portfolio.
So you're seeing everything starting to bounce back since the pandemic?
We were. I think there's been a bit of a slowdown once the cost of capital really flipped in the last 3 months.
Well, yeah,
right. You caught me at an interesting time, right? If you would have asked me this December, January, I would have said, yeah, I mean, we are smooth sailing to a really nice recovery here, right? Now you ask me today, I'll tell you that there's going to be a contraction. I believe that there's going to be a contraction in the market, right? I just think that that's naturally going to happen. Again, I'm not sure that really affects the boutique tenant base that we focus on. I think it might really, affect some of the larger tenants in the market. But more importantly, outside of tenant base, because I don't think we're going to start shedding a whole bunch of tenants or anything like that. What I think is, it's going to be harder for some landlords to refinance if they have loans coming due, right? Because of the cost of debt. It's going to be harder for it's going to be harder for lenders to put out money for say construction loans and things like that. It's going to be harder to see forward 12 months or project out 12 months with the uncertainty in the financial markets. So I would tell you that we were in a nice recovery. I think we're going through a little hiccup, but I do believe, on the other side of whatever is coming in the next kind of 6 to 12 months, I think we'll be back, right? Do I think that we're going to be back to the occupancy rates across all submarkets the way we were in 2019? Maybe, but I think that we'd be, delusional to think that there hasn't been some shift in the way people office and use office space. I don't think it's going to disappear. I think work from home is, not sustainable in the long term. But I do believe that I think as companies really start to come back, really hit the gas, they're going to be very picky on where they come back to, right? And they're going to start making decisions and say, hey, if we save a little money by having, say, a smaller space and working from home some parts of the day, can we focus more on having a better space, more high-end space, more technologically advanced space? Maybe some of those things happen. And look, we think that we're positioned well. I can't speak for anybody else. I can say that I believe that we're positioned well within our portfolio to do well in the next phase of the office market, future of the office market, I should say.
Now, are you strictly going to stick with the office market, or are you considering even going into residential or even retail?
Look, we have retail, right? When we say most Manhattan is mostly mixed use, right?
Yeah.
When you hear the words mixed use, that means retail and residential. But right. Mixed use just means it could be commercial and retail, right? Every single one of our buildings has retail in it. Retail in some of these markets, specifically Soho, used to be the driving factor for acquisition. We don't think of it that way. We've signed retail leases, healthy retail leases comparative to the market, and we think retail is going to continue through a recovery. We can do a whole separate podcast on what I believe the future of retail is, because I think it's absolutely fascinating. I'll give you my 30 seconds on it, right? I think
I'd be interested in that.
Yeah, no, I mean, my 30 seconds on retail, I think there's been a bit of an overcorrection to the online business model. Not to say that online is going to dominate 100%, right? I use Amazon more than anybody, right? I want it instantly. But you get to certain things that it's going to be a bit anecdotal because we don't have time to get into the real specifics, but you get into certain things where it's like you buy online, you send back, and you get into the younger generations, right? The Gen Zs that'll start saying to you like, man, I'm so sick of this. I wish there was just a place I can go try on this T-shirt before I buy it. Like, yeah, it was called a store, and you guys put it out of business. So no. So look, all jokes aside, I think that's the overcorrection. I think, for example, what's on the forefront of retail, I think it's a mixture of online sales and in-store sales and experiential. So I'll give you two examples out of Soho really quick. One, I'm always impressed with is Zara, right? Zara used to have, say, a 20,000 square foot footprint. They've shrunk that down to, say, 5 or 10,000 square feet. And what they do is they'll have a T-shirt in store, right? And they'll have it maybe in 2 colors, but available generally in, 10 colors. And what they'll say is, by the way, I also have this T-shirt in the other 8 colors. Try it on for size. And if you don't want one of the 2 colors in the store, we'll ship it to you. You'll have it in your house tomorrow, right? Great concept. So you get a mix of both. The other one is Nike, right? There's a Nike store. It's probably 6 stories high. 4 walls. There's 24 available walls for shopping, right? Available walls where you can put products. There might be products on 3 of those 24 walls. The rest of the Nike store is, full of all kinds of really, really cool things. And the reason I bring that up is this is where it gets into the tech side, right? You walk to the Nike store, location services, cookies, everything realizes you're in the Nike store. You might scan something. There's a lot of, QR codes to scan. You might scan something. All of a sudden your phone knows you're in the Nike store. Now there's 3 walls to shop on maybe, and I see tourists down the block waiting to get into the Nike store, Zara also, but just into the Nike store. And they barely sell anything in there. So what'll happen is 3 months later, maybe they'll be scrolling through Instagram and, the same Nike sneakers or something that they might've seen pop up and say, 30% off these Nike sneakers. Somebody saw them there. Oh, okay. Then they click on them online and they buy them online, right? Now, the ad would have never come up if they were never in the Nike store. They would have never seen the sneakers if they weren't in the Nike store, but they bought the sneakers online, right? How do you attribute that sale, right? How do you distribute the portion of the sale that should have been attributed to that experiential piece of retail that Nike keeps in Soho? And how much of that should be attributed to the online sale? It's a really fascinating concept that companies are struggling with. But
yeah, and I think a lot of companies have diverted some of their advertising funds towards that type of marketing, because people want that kind of interaction when they go shopping, and I think people do like to get out.
They do.
They don't want to sit behind the desk and order.
I wish we were here. If we were here and walking around, I would tell you I'm across the street from. I can see Oh my goodness! I wish I could show you my computer. I'm seeing Foot Locker right across the street. There's a drop, what they call a drop. Sneakers are dropping today. I love sneakers, and I know which ones are dropping. They dropped online. So that just means there's a sale going on in those sneakers, and they're releasing them today. There's about 100 kids. When I say kids, they're probably anywhere between 15 and 25, and there's about 100 of them pushing their way onto the line. It feels like 110 on that street waiting to get into Foot Locker to buy those sneakers.
So
you can't tell me retail's completely dead, because whatever's going on out there will tell you otherwise.
Oh yeah. And between the social media and the designs of the stores, I think it gives those people that they can go out. They can sort of interact with in the retail store and get away from being inside all day. And it's
it's unbelievable. Look, I think that I couldn't tell you what the future of retail is, but I will tell you that there are a lot of really great direct-to-consumer brands that want to have a foothold in New York City, right? That did well. Sorry, the emails coming in. That did very well online. And they're like, okay, now we need to become a real company, right? We need a foothold. And where do we need it? We need it in New York City, right? Everywhere else is BS. You need it in New York City. Where do you need it in New York? You need it in Soho. You need it Fifth Avenue. You need it Madison Avenue. You need it on Bleecker Street. You want to be not where your online clientele is, let me rephrase, not where the majority of your online clientele is, where the majority of your online clientele wants to be, where they want to hang out. All the people walking around Soho, that 100 kids out there, none of them live here. right?
Right.
They came from Queens, from Brooklyn, from wherever to go to this Foot Locker in this Soho because that's in Soho, this Foot Locker because that's where the drop is. And it's just it's fascinating to see. And you know,
And
it's
New York City has always been like that world hub.
it
People
is. It's the
coming
greatest city in the world.
here.
Look, I'm a big proponent, but I've been to I want to say almost every other major city in the world. And I think bar none, New York is untouchable. It's got everything. It's got the best version of everything you're looking for in the world, you know, including cuisines, right? I would put it up. Our international cuisine is
Right.
just as good as like, you want good Italian food? Yeah, there's some in Italy. There's some in New York.
Yeah.
French, same thing, you know?
Right. It has everything
you know,
to offer.
it's got everything to offer.
So
yeah.
let's get back to KPG because
Yes.
they also are trying to find something for everyone as well. Well, not for everyone. The
We're
1%
not.
let's keep it to the 1%.
Listen, we're expanding. We always say that we want to create a not a cheaper product, but a more affordable product. And we're always looking for the opportunity to do that, right? We're not just because all the leases we've signed historically are over $100 a foot doesn't mean that that's, you know, where we want to maintain. We're always looking for a way to expand the brand, make it more accessible to everybody.
Well, that's a good point because, you know, right now, the way things are, it's so difficult to create that product, that affordable product. I mean, everyone really wants to, but unless you
Hermes never did it. Louis Vuitton never did it. They just keep raising their prices. Patek Philippe never did it. Audemars Piguet never did it. You know, like they never made champagne any cheaper, but yet you can't keep it on the shelf. They never made those bags any cheaper, yet the women will do anything to buy one. They'll stand online, they'll, you know, whatever, they'll beg, borrow, and steal. Same thing for luxury watches. So I think there's been a shift in the market to luxury products and luxury goods. I think just like everything else, I think the entire world, just the sales market has compartmentalized into sort of two segments, right? It's the luxury market and then the affordable market, right? So like what does well? Ultra luxury projects, you know, LVMHs of the world. And then, you know, what else is doing well? Walmart, crushing it. Walmart, you know?
Right.
And that middle ground is having a tough time. So we're seeing the same thing in office space, right? There's kind of the luxury market, the new builds, like take, you know, SL Green's, not just our, you know, boutique ultra high-end product, right? Take Hudson Yards, that new build product. Take One Vanderbilt, broke every leasing record in the world, right? People either want that or tenants are out there searching for the most amount of space they can get for the cheapest amount of money, right? It's either that or a race to the bottom. That's what we're seeing. That's at least what I'm seeing in the marketplace. And we'd rather be in the sort of high-end space than the low-end space.
I think that's a smart move, especially with how you like to design your product.
We do.
You know, I mean, you know, that's something I think a lot of companies are looking for, that particular design, the high end.
The high-end design. You should come, you know, and tell everybody, you should come see some of it. Like pictures don't do it justice. You should come see some of it. We do the little things, and this is what I love talking to people about this. We do the little things that nobody else does. The people think they can, you know, that people think they can copy, but they never get right. Like we have massive marble slabs in our kitchens, massive. And then I walk into other pre-built spaces and I knock on it. I said, is that plastic? They say, oh, that's Caesar something. Like if you from 25 feet away, it looks like marble. You walk up to it and you're like, what is this?
Yeah.
You know? And we do the little things. Like in some of our buildings, we have 14-foot ceilings. You know what we do? We put 14-foot glass up. Is that custom? Absolutely. Standard glass, 9 feet, 7 feet, 8 feet, 9 feet, everything that after that custom. Why do we do it? Because that incremental cost pays off when everybody else is standing and having difficulty leasing, and we're breaking leasing records, right? We think about it from the same way that the tenants would think about it, and we think about it from our design perspective. We want to create a high-end brand with the nicest product in the marketplace. The brokerage community already knows if they come into a KPG building, they're going to get a certain level of finish, a certain level of product, and we want to continue making that product, right? When we just closed a construction loan for a new building on 14th Street, right? Or for a building we're going to start doing the work on 14th Street. It's an old building. this building is an absolute ugly duckling, right? It was originally a very pretty building, had some design to it, 132 West 14. It had some design to it back when it was built in 1920, and at some point through its life cycle, somebody slapped a horrible like concrete facade to this thing. I mean, just absolute awful. And we walked into the building. We said, oh, you know what? On the inside, this is some building, right? And then we go up to the roof and we look at the views, and the views are just spectacular all the way south. You can see the World Trade Center. And I'm like, wow. And so what we said to ourselves, like, if we come in and do what we do, right? We renovate this asset. We rip that ugly facade off. We bring in a very cool architect. We brought in Marvel Architects, which is really high-end architect, really cool design stuff that they do. We're going to build this beautiful glass facade on this thing and renovate the interior of this building and tear out everything and start new. And we're going to have a jewel, right? And we're going to be, and it's in Greenwich Village, exactly where everybody wants to be. Hustle, bustle, tenants can go outside and go to their favorite restaurants within the next 5 minutes being by their office. And that's sort of the next, that's the next project. And we're looking for more.
Is that also driving a higher or longer term lease with the tenants?
Part of our success story has been flexibility. We work within the tenant's needs, right? Do we want a 10-year lease? Sure. Will we do a 7? Will we do 8 or 9? Will we do a 5 or 6? Everything is dollars, right? It's all dollars and cents to us, right? We underwrite, we look at it very specifically and we say, hey, does it work for us? Does it work for our business plan? Do we feel confident? A lot of tenants will say, I'm nervous. I'm taking a, say, 8,000 square foot space now, and what happens if I need 15,000 square feet? You say, hey, if we have a larger space in our portfolio, you can move within our portfolio. They say, oh, we're not sure. We need some flexibility. Say, tell me what you need, right? We're not rigid, and we're very small. We're a very nimble company. My partner, Greg, he runs our leasing, right? I run acquisitions. He runs our leasing and asset management, right? Construction included. And we're hands-on. We're in there, right? We don't delegate down to the staff. Everything is personal, right? We know our tenants personally. And when somebody comes in and they make us an offer on one of our spaces, we work with them. They say, well, we need certain things. Tell us what you need. How do we make the deal work, right? We're not, I think, being a sort of smaller, nimble corporation, that really helps us accomplish some of those things that maybe some of the larger companies will push down the chain of command and will kind of get lost in the fray. So
yeah, that's always going to be the part of a success when from the top, working on each product.
Maintaining quality. It's quality control, right? How do you maintain quality control?
Yeah. It'll be just the way you want it.
We're working on it.
Yeah,
it's got it. It's everything. It's everything.
So what's the future for KPG? You have that crystal ball?
Yeah. In the next couple of years, we're going to buy. I think we made it to about $500 million worth of real estate thus far between the two funds thus far. In the next, year to two, I want to add another $500 million for a full $1 billion portfolio. Like that's what I think is accomplishable for KPG, right? We want to start focusing on boutique buildings, but maybe a little bit larger, right? We have some assets in the portfolio that are, 40, 50,000 square feet. I'd like to focus more, on 75,000, 100,000, 150,000 square foot buildings. Now, I don't want to get too big that we lose who we are and what we do, but I do want to take bigger bites and bigger chunks. The problem historically that's existed was the areas that we want to buy in are high barrier to entry and limited supply for a reason. Buildings just aren't that big, right? It's not like you go out to Midtown, and there's 1 million square foot building that you can buy, right? They're very limited to find big buildings in the markets that we want to own in.
Right.
So we've been focusing our attention on trying to buy more assets and, rinsing and repeating the product. We want to build one of the most recognized, I want to build the most recognizable brand for office space in the city. I want the tenants to know that going into a KPG building means something. And the brokers already are, like I said, are starting to know that if we're delivering a space to the market, it's going to be a certain level of quality, and they should expect it, and they should get their tenants prepared for that. So that's the future for us, is selfishly more, and maintaining that quality control to make sure we keep delivering that product.
Well, I wish you luck with that. So, Rod, if someone wants to go to your website, what's the website address?
It's kpgfunds.com.
kpgfunds.com.
Funds, yeah, kpgfunds.com. They can take a look at the stuff we own. They can take a look at some of the assets. There's some really, really cool before and after shots. We didn't really get into it, but some of the assets we bought were untouched for generations, literal family generations. Buildings that were bought in 1940 and nothing's happened to them since we got in there and started renovating them. So, buildings that are built in the 1880s, 1890s. So we have some really, really cool sort of before and afters over there.
Well, I appreciate you coming on our show. And we've been talking with Rod Kritsberg. He's the CIO and the co-founder of KPG. Yeah. And I wish you all the luck, Rod.
Thank you. It's been a lot of fun.